There's no doubt that the current situation is outstanding. And that's not, no one disputes that.
What do you mean the coincident indicators are good?
The question is where we're going to go from here. So the Fed is trying to engineer a soft landing, as they always do. And the question is, are they going to be successful, or is it going to be worse than that? And I think the markets were assuming that things are going to be okay, but now I think the consensus has shifted a little and think the risks of things being worse than that has risen considerably. Whether it will or not, none of us know so far. But I think stocks have been priced maybe a bit too high for that. I think they've come back to the point where now you represent good value. There's a risk premium restored, and I think you can buy with some confidence here.
So basically buy the dips?
Yeah.
Back on?
I think that's back to the... And we'll see whether the Fed has gone too far, whether we do see a more precipitous drop in some of the economic data. I hope we won't, but I think you have to acknowledge at least that possibility and then not pay too much for the perfect scenario.
We had Scott Minerd on the halftime report last week. He said 50% chance of a rate cut in 2019. Do either of you agree?
No, I don't see that. No.
I think it's possible. The key thing the Fed has to deal with, and all of us have to deal with, we just don't know the answer to, and that's what's normal. So the Fed is trying to normalize policy, but what's the normal interest rate in today's world? If you look, I think the key of what the last several years tell us is we had the most aggressive monetary policy in human history, and you did not see a big jump in inflation in the developed world. You did not see a huge increase in credit. So when you think about what's been happening over the last 6 months or so, Europe has been weakening despite the fact they still have basically zero interest rates, negative real interest rates. Japan is struggling to get its inflation rate up. So I think it's quite possible that the neutral rate is actually somewhere close to the low or mid twos. That is where we are, maybe even a little below that. So the Fed is trying to find its way. There's no game plan for going off zero interest rates because it's never happened before. So they're trying to model it, they're trying to look at the data, but none of us know really what the right neutral rate is. And I have a feeling that in an older demographic in the United States and many other developed countries, that real rate is probably pretty close to zero.
Mohamed El-Erian had an interesting tweet last week just saying, look at all the grief our Fed is getting versus the ECB, which is tightening rates while their economy and their markets are under so much more pressure. It's a valid point.
Yeah, and I would argue that we're probably looking at something more like a mid-cycle slowdown, right? We saw the data breaking down in Europe in the mid part of last year. You know, we're rolling over from very, very high levels, but in order to think that the Fed is going to cut, you basically have to take some of the best predictive tools that we have, things like the yield curve or LEIs, and say, okay, they're going to stop working, right? Because the yield curve is the best predictor of business and economic cycles out there. And as long as the yield curve is positively sloped, I think the odds of recession are very low. Now, once the yield curve inverts...
People raised those odds as it flattened. You know, that was...
Well, flattening yield curve is not necessarily a warning sign, because what people forget is the yield curve can stay flat for a long time while the economy does, and the markets do quite well. In 1995, the yield curve flattened, and over the next 4 years, it averaged 36 basis points. Meanwhile, the economy grew at 3.8% per annum over that time.
That period is an interesting sort of analog to today, the late 90s, even going back to the Fed and trying to figure out whether they should be cutting rates or raising them, and then they were too timid, and then we had the kind of liftoff at the end of the decade.
Yeah, and people said, you know, the Fed was behind the curve, et cetera. They kept rates too low for too long. I don't know if they're going to face that same criticism today, but I do know they have to solve for this jobs market. And, you know, going back to the importance of jobs in the economy, you know, companies don't hire people that they don't need. Right, so there's some fundamental strength going on here at the corporate level that's outside of the, you know, the dialogue in Washington, D.C. or anything else related to trade or trade war, all these other issues. And it's telling you that there's still a strong argument for U.S. growth.
As this cycle has been, doesn't it seem to you guys like the bigger risk is that we get melts up a bubble, in some sector? If you look to stocks like we were just talking about in the late 90s, if you look to housing last time, I'm not saying that anyone should welcome this kind of sell-off, but is it a bigger risk that we saw something like last January where everything started to go parabolic, Ed?
Well, I think you want to ideally have more orderly markets that march higher over time and occasionally correct. So this year we're going to end up with a down year unless we have a huge day today. But it's only S&P total return about -5%, not exactly a disaster. And so having these pullbacks every once in a while where you put some risk premium back in and increase the longer-term attractiveness of stocks, I think that's actually pretty healthy.
I wonder if we look back at if the Fed, the criticism is they waited too long, but there was no inflation then.
either. Why should they have been raising back then if they shouldn't be raising now? And I'm just wondering whether we're missing something with the internet. I don't know. It just seems it's so hard to generate any inflation that don't be afraid of the prosperity. Until you see the whites of the eyes of inflation, you don't know what normal is.
Well,
maybe there's something to be said for all the shadow employment thing. Remember the big debate about does it matter that people are kind of out of the labor force?
Yeah.
Maybe it does. Maybe they are.
And they're not all boomers. They're 25 to 54-year-olds that are back to the back to the
they're
millennials.
trying to get to normal, and then the question is where we get there.
Yeah.
And if you can't normalize now when the economy is strong, when are you going to normalize? If you had done it back, 5 years ago when the economy was really weak, maybe that would have been premature.
So from a portfolio perspective, you had opportunities in 2018 to look at emerging markets. You had opportunities to look at high yield investment grade. Are those things to give you the diversification in 19 that you should be allocating towards?
I would be allocating toward the cyclicals, like the higher beta sectors, simply because they have been the area that are most sensitive to economic growth. And as people have gotten, more concerned about this cycle coming to an end, they sold off the cyclicals, the really high beta stocks. They sold off emerging markets most violently. And I don't think we're at the end of the cycle. I think this cycle is going to end up going on longer than people think. So I don't see the Fed cutting in 2019. I don't see a recession starting in 2020. So my hypothesis is that this is a cycle that's going to go on for longer than people think. So therefore, I think your real value is in those cyclicals, in the materials and industrials and tech you were talking earlier, emerging markets as well, because I think that the dollar stabilizes. And I think in the end, there will be an inflationary story that the Fed has to solve for, because you take a combination of relatively good economic growth, tax cuts, and fiscal stimulus, you put those things together, and we know how it ends. It ends with inflation.